two big hedge funds just fell off a cliff like this stock chart has done. And we're going to watch a video where George Gammon is talking about, holy crap, two subprime hedge funds just blew up exactly like Bear Stearns. So let's watch this together.
Just saw two more hedge funds blow up. Like Jamie Dimon says, we're starting to see all these cockroaches, and it's eerily similar to what we saw in 2007. So this begs the question, is the future looking into 2026 going to play out just like 2008? I'm going to reveal the answer.
So again, this guy, he does doom and gloom on his channel probably twice a week, every week, right? At some point, he's going to be right, but he's hedging his bets over and over and over, over and over and over and over and over and over, talking about collapse, 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 crash, crash, crash. It's going to be awful. No more jobs. Flash crash right there. This feels like 2008, right? The Big Short 2.0, etc. But maybe he's got some interesting information that we can learn.
For you in 3 simple fast steps. Step number 1, let's go over WTF just happened. And actually, before we get to WTF,
hey, look, that looks like the market cycle right there, doesn't it? I assume that that's a Bear Stearns chart that he drew right there, but that looks like the market cycle to me.
Just happened, we're going to go back and look at what happened in 2007. And they say history doesn't repeat itself, but it rhymes. But in this case, it looks like it's repeating itself step by step. Let me show you what I'm talking about. We're going to look at a chart of, yikes, Bear Stearns. And in 2004, 2005, 2006, hey, the future's so bright, you got to wear shades.
Let's do this together, right? Before we started the replay that you're watching right now, I want to talk about you signing up and joining us in the US Investing Championship. But what I wanted to talk about was the market cycle here. All right. Bear Stearns went through that market cycle. This stock that we just happened to pull up right here when I was just browsing around, Cake, is in the market cycle, right? It's round tripped the market cycle. Bear Stearns round trip the market cycle. Now, where do we know where to get in versus where to get out? Number one, all stage ones start with sideways movement. Now there's going to be uptrends and downtrends inside that sideways movement, but all stage twos actually start where the stage one uptrend begins and doesn't stop, and it's going to push harder and faster. Now we determine a trend using the outlier trend template, the 10 EMA, the 20 EMA, and the 50 EMA. And I get people ask this question all the time. On what time frame? Doesn't matter. Works on every time frame. The 1 minute, the 1 second, the 1 month, the 1 day, the one anything. It always works because it's math. When the 10 is over the 20, price is over the 50, that is a bullish trend. Now, again, stage one, it can go sideways, up and down. Stage two is where the bullish trend starts and doesn't stop. Your job as a trader is to identify when stage one has happened and stage two is beginning, and you have that bullish uptrend, and then you just ride it all the way up. Stage three is when the moving averages start crossing over, right? Stage three is up here when the moving averages start crossing over. And this is where a lot of people buy in, right here, right at the top. This is where most people buy in, is right at the beginning of stage three, which is why most normal people suck so bad at trading, because they buy the top over and over and over. And they always wonder, what did I do wrong, right? They're buying right up here. And then stage four is where the 10 goes under the 20, price goes under the 50 and doesn't stop and comes down like this. Now, a good thing to remember is you want to buy stocks as they're crashing up, not as they're crashing down, because right here just proved it can go from 46 up to 69. Let's do this together. Let's go 46 to 69. That's a 50% increase. And then it can go down 33%, because the math works like that, just as fast. Just as fast as it went up, just as fast as it went down. Your job here is to know when it's going up, get out of the way as it's going down, and we don't know how far down it can go. So if you're trying to dollar cost average into a stock, you're way better off buying it on the way up versus buying it on the way down, because you don't know how much lower it can go. But if it's already on the way up, you're to profitability that much faster. All right, let's continue on. So here we can see the market cycle right here. Your stage one, your stage two, your stage three, and your stage four. You would have known to get out of Bear Stearns before Jim Cramer went on saying, don't worry about it, right? I'm sure that that is a real thing. I've seen it before. It's going to take me too long to find it. But what's his name? Jim Cramer went on talking about how Bear Stearns is fine. There's nothing to worry about. And then it was over. You would have been completely out of it before that ever happened if you understood the market cycle. But let's keep going.
AIDS, right? And oh, by the way, we go out to about April or May of 2008. And then on the left, we go from 0 up to $175. This is their share price. So you can see it peaks out, oddly enough, right in January of 2007, and it starts to go down. Now, I've got this first kind of decline right here circled in red. Why? Because this is when Bear Stearns started to close down some of their funds, some of these subprime funds. And what's really bizarre, or just kind of
By the way, Frank nailed. This is exactly what happens to most investors. Stage one, maybe there's something here. Stage two, oh boy. Stage three, what the frick? Why isn't it going up anymore? It should be going up. And stage four, oh shit. Yeah, exactly. Well said, Frank.
again, eerie, is that these subprime funds were referred to as high grade. The irony, right? But wait until we get into what's happening today. It's not just that we have similar types of subprime funds blowing up, but they're also called high grade. No kidding. You can't make this stuff up. So anyway, we have Bear Stearns come out and say, yeah, nothing to see here. It's got a couple issues.
There's your stage three right there. Like legitimately, that is stage three. You would have seen the moving averages crossing over at that point. Question mark right there is get the frick out the way. Not that hard. Well, it's not that hard when you're an outlier. It's not that hard when you understand. For everybody else, this is the hardest game ever.
Issues just do this subprime thing, but it's contained. It's contained. We're just going to close down these funds. And again, nothing to see here. We just go ahead and sweep it under the rug. Now, what's interesting is the funds they were closing down didn't necessarily suffer massive losses. It's they had one or two funds suffer losses, and then everyone started to get scared. So even though the other funds didn't suffer massive losses, they suffered massive redemptions. Massive redemptions. And therefore, what happened is Bear Stearns.
Oh, hang on. So I worked in the banking industry for 12 years. I didn't realize that I get to throw my expertise at this. I may give some really strong insight here in just a couple of minutes. Hang on. I'm going to see where he's going here first.
Had to sell all of the assets they owned. And at the time, there wasn't that much liquidity. Sound familiar with today? And they had to fire sell these assets. They had to take a big haircut. And that's
all right. My turn. So funds closed. Now, redemptions, that is a problem. Now, consider this for a moment that the banking industry operates on what's called a fractional reserve. Okay. If you go deposit $100 in your institution, whatever that institution is, right? Bank of Texas, Bank of America, Bank of Idaho, doesn't matter. They operate on fractional reserves, meaning that for every $100 deposited, they may keep literally on hand, like in cash, 10 cents out of $100. Okay. Now in cash deposits, right? Available funds. I don't remember the regulations. I feel like it's 8%. So that means $8 of every 100 that they take in as a deposit, they keep. The other $92, they go invest into longer term investments. Like, I don't know if you know this, but banks, financial institutions do investing on their own, right? They will go, they'll buy CDs, they'll buy mortgage-backed securities, they'll buy whatever, all over the place. And then they will also loan that out, which makes sense, right? Now, the institutions have to balance the risk and return, right? Because a 30-year mortgage at 3.5% is a lot riskier proposition because it's low rate for a long time than today. Probably in the CD market, they could get, I'm spitballing here, I don't have any idea, probably 5.25% CD for 8 months, right? Now, that is a significantly higher value asset, but it's only for a shorter duration. Okay. So what happened a couple of years ago when there were bank failures, I was right in the middle of this. Now, I wasn't caused bank failures, but I was having conversations with credit unions about specifically what happened. Silicon Valley Bank was one, and then there was one in New York that happened just right after that. And I was having conversations on a daily about this. The issue was that there was perceived illiquidity. So somebody tried to get their deposits, and the institution was like, okay, hang on, we need to go sell off an investment because we keep $92 of every $100 invested in something else. We need to go sell off an investment in order to pay you back. Okay. So let's say it's a $100 million institution. They keep $8 million liquid, and this person had $10 million that they needed to withdraw. So they needed to go take out not just 2, but they need to go take out 10. Otherwise, they have nothing left. So they go take their investment and they cash it out early. They're going to take a loss on that investment. Okay. So if they bought it for 100, they might have sold it for 97. So they're taking a haircut right there, which is not great. Now, that person got their deposits, but in the meantime, and this is what a bank run is. Okay. In the meantime, that person, let's say that it was Tyson Finley who needs a 30-to-1 leverage, is what he's saying. Let's say Tyson Finley called and he's like, I need my $10 million. And they're like, okay, Tyson, hold tight. So they go pull Tyson's $10 million out of their other investments, and then they pay Tyson back. Tyson's made whole. There is no issue here. But Tyson told his other high net worth individual friends, guys, I think we got an issue over here at Silicon Valley Bank. And so all of his other friends are like, we got an issue? And Silicon Valley Bank is like, no, there's no issue here. We'll go get it for you. And that delay, they had the cash, but they had a delay caused the issue. Now, the redemptions, like he's talking about here, is exactly what we're talking about. The redemptions, meaning the investors, the depositors wanted their money right away. So therefore, they had to wait for those assets to be sold off so that the bank could pay them back. Now, because of that, more and more people were coming through saying, give me my money. And those investments that they bought at 100 were now getting worth less and less and less and less and less. And they were probably selling them for 80 cents on the dollar, 70 cents on the dollar, right? And so they're I'm going to use round numbers here. Their $100 million institution, by the time they had to take those early withdrawals on their investments, was now a $70 million institution. And if you have $80 million that needs to be withdrawn, and you only have 70 now because you took a haircut on everything, you got a major problem here. That is exactly what happened to a lot of banks and a lot of institutions, not just in 2008, but just a couple years ago. That happened again, and it has everything to do with timing and how quickly institutions can get those funds out. Okay. So I don't know if that's happening here. That's probably over a lot of people's head, and that's okay. But the point is that every investment that the bank makes, every loan that a bank makes, has a market value. Okay, and if we need to get out of that right away, the market value gets chopped. Right. If I need to redeem something right away, it's not worth 100 cents on a dollar anymore. It might be worth 95. And if I'm super underwater on it, meaning that I took out the investment when it was 4%, and now that investment today is worth 5%. Nobody wants a 4% investment when they can go out into the marketplace and get a 5% investment. So therefore, I'm going to take an even bigger haircut on my investments, and I might only get 80 cents, 70 cents on the dollar. This is exactly what I did consulting for 12 years. So I have a tiny bit of experience here. So if that was way too much, I understand. Type a 1 in the chat. If that was actually a good explanation, thanks, Chris. I appreciate it. Put a number 2. And I'm not looking for number 2s. I'm just curious how many people followed along or how many people tuned out.
One of the main reasons that they had to close these funds, it's one of the main reasons you saw this big decline in their share price. So who cares, George? What does that have to do with what's happening today? I'm glad you asked. So just the other day, UBS came out and said they were closing down some of their subprime funds. Now, it's really interesting, and I got to give a big hat tip to my good buddy Jeff Snyder, who did a podcast on this. So going back to UBS, one of these subprime high grade funds that they had a tremendous amount of exposure to First Brands. Now, the other fund didn't have really any exposure to First Brands, but everyone saw what was happening over here, and they didn't want to be the last person in the movie theater to rush toward the exit. So what do?
Which is what I was just talking about there, right? With that bank run.
They start the redemptions. They say, give me my money back. And all of a sudden,
this is exactly what we just talked about.
UBS says, well, some of the underlying assets aren't that liquid, so we have to go ahead and close the fund. Now, what's happening here in the monetary system? You guys know from watching my videos that the monetary system is simply a network of bank balance sheets. So if you have UBS starting to, let's just say, struggle in a very similar way to Bear Stearns starting to struggle in the middle of 2007, that's going to have a ripple effect throughout the entire monetary system. How? Because perceived counterparty risk goes up, because everyone at these money dealer banks knows that UBS's balance sheet could be connected to a lot of those counterparties that they may be lending to. So risk goes up, liquidity goes down, regardless of what the Fed is doing with their balance sheet. In other words, QE or QT. So just to make sure we're all on the same page, the similarities here are that in...
I knew it was you, Tyson. I knew all along it was you, dude.
middle of 2007, we saw funds closed by Bear Stearns. There were these subprime funds that, oddly enough, like we said earlier, were called high grade.
Hey, look at that. Excel with Rami. Spot on. I worked in banking for 11 years. Cool. We have the same background. I agree. Cheers to you, Rami. Good to see you.
They started to close these down, and then they got a massive amount of redemptions, which has caused a doom loop because they have one problem over here.
That's the doom loop that he's talking about is what I just described, right? People getting nervous that they can't get their investments back, so the bank then has to liquidate those funds and take a loss on the investments, which then tells other people, hey, this is no longer $1 billion institution, it's an $800 million institution, and then it's a doom loop. Exactly. This is really cool.
They get redemptions over here, which causes even more problems, which causes even more redemptions. And we could see the exact, well, we definitely see the exact same thing play out just the other day with UBS. Now, will it lead to a doom loop? TBA, right? We'll go over that more throughout the rest of this video. But the key here is to realize that none of us can predict the future. There are no certainties, only probabilities. But what we're seeing right now with UBS, private credit, shadow banking is exactly what we saw in 2007. Now, I know the pushback is going to be, George, what are you talking about? You're always too bearish. I mean, right now, the S&P 500 is at all-time
He is always too bearish.
highs. And everyone knows it. Sure, we've got Tricolor and First Brands and, I don't know, some other cockroaches out there. But this is totally contained. There's no systemic risk to what's happening in the shadow banking system and in private credit. Well, I'd like to remind everyone that's exactly what they said right here. Now, you may be asking yourself, okay, George, why do you have this second portion of the, let's say, downtrend, to put it nicely? Why do you have this circled? Because right around here is when the S&P 500 was hitting all-time highs. So if you were someone back then that was worried about what was happening with subprime, say, mortgage-backed securities, you would have heard the exact same bullish arguments that you hear today. And oh, by the way, let's remember, Ben Bernanke himself even said that subprime is contained. Just like today, they're saying that subprime, although it's just in the auto sector, is contained. And again,
I want to point out something real quick though. As much as he wants to tout doom and gloom, right? What we as investors can do is know when to get into a stock and when to get out of a stock using the market analysis that we talked about earlier. But these kind of systemic risks, we can't do anything about. Like I genuinely want you to understand that even though we as investors can know when to get in a stock and out of a stock, riding the trends up, getting out of the way on the trends down, if there is systemic risk out in the marketplace, that's beyond our control. And that definitely sucks. Definitely sucks.
and what they don't realize is even if it is contained over here, if that increases counterparty risk, then it's going to decrease liquidity, which could lead to problems that are not contained. And the real danger I'd like to highlight is right here. We forget that a $75 stock can
The market cycle, baby, is real.
go to a $0 stock in the matter of just a couple days.
By the way, that now as exciting as he wants to make this, oh my god, can you believe this? A $75 stock can go to a $0 stock. This is impossible. No, I can't. Ooh, I should be so scared and leave my money to the professionals like George Gammon here. Okay, notice what's happening. Notice what is happening here. It is obviously in a downtrend. And we've done this many times over. We've done this many times over. But stocks don't generally crash from all-time highs to zero. Now, can I say that that is impossible? No, of course not. There's always market risk. But there are a lot of people who see what's happening and get out before things like this happen. So I want to look at 1987, the worst crash in the history of time. 1987, 10:01. Okay. Chris was just an itty bitty baby boy then. Oh, I got to go to SPX to do that. 1987. This is no. Hold tight. 1987. There. Yeah. Go. There we go. Okay. Before the big 38% or whatever crash that happened on that day, you had warnings. Your 10 was under the 20. Price was under the 50. A solid week or two before the big nasty crash. Right? Let's go to the COVID crash, 2025 or 2020. 0101. That's fine. January 1st, 2020. You had warning before the big COVID crash, right? The same thing will happen on any stock that you're worried about. You're going to get advance warning. And Goody, by the way, I see your super chats. We've talked about this, my friend. Stop sending super chats. I'm here for everybody, right? And I don't want anybody to ever feel like they need to send me a super chat. I'll discuss those in just a couple of minutes, though. I don't want anybody to ever feel like they are completely lost in the market when the market tells you the direction it's going. The market will tell you which direction it's moving. So don't be scared. Don't listen to people like this who want to get you into all the fear.
But unfortunately, there are other things that are happening right now as we speak that are not like 2007 and they're not like 2008. They're actually much, much worse. And we're going to get into that right now.
I want to point out this comment real quick. Probably the best thing is to wait for the crash, wait for the bottom, and then buy 6-month calls. Okay, if that's your plan, price hunter, it could turn out amazing. Honestly, it could turn out great, but we got some issues. I mean, if this little thing right, if this little thing right here is your entire trading plan, we got some issues with this. First, how long are you going to have to wait for that crash? Right? There's people like George Gammon who are going to tell you prices are going to crash. Like legitimately, he's going to tell you this twice a week, every week. Everything is collapsing. Like 4 months ago, is it time to panic? A dollar collapse. This is what he does. However, in those 4 months since then, let's go to today. Hang on, I guess I just have to drag it over. Let's go to today. In those 4 months, the SPY has been going up and up and up. Right. So if you were just waiting because, somebody like this is like, oh, it's going to crash, you're going to permanently wait. Right. And then when it does this, he's going to be like, what he's going to say is, this is just the beginning. Don't be scared at. In fact, let's go to that. Let's go to March. March was when 7-8 months ago. This is scary. What just happened? More inflation. This changes everything. It's only beginning. Right. He's going to tell you, oh, it's going to go down even further. And if your strategy is to wait for the crash, you're never going to find that. So instead of waiting, just have a plan, look for opportunities, take the opportunities, right? Now, can we say what day is going to be the absolute bottom or the absolute top? No, but we can use that outlier trend template to help us along the way. All right, so Goody asked some questions. I want to answer those questions real quick. Let's see. Why roll up? Okay, so this goes to the rolling conversation that we have in our trading room. So one of the things that we do is we buy deep in the money long calls. For those of you who don't know, I put all of my trades out there. In fact, I just got long in the market yesterday. I put all my trades out there inside of our Discord in our afternoon trading rooms, and those trading rooms turn into live replays. They'll be replayed the next day. So all of my trades are out on YouTube permanently forever. Okay, so in that, Plan M and Plan A, our most aggressive plans, use deep in the money long calls. Yesterday, we're in Plan ETF as of now, and all we got to do there is buy shares. And so, Chris, why roll up when an 80 delta call becomes 90 delta? Why not keep it? How does rolling up lock in profit and give a credit? I get the ATR. I just want clear, deeper understanding of the mechanics. Okay. So let me pull up into, I know I went over this, but that's okay. I got you. Let's pull up a spreadsheet here. And we're going to do the math together. And I got you. All right. So let's pick a stock. Let's pick SoFi. Everybody loves SoFi. Let's go over here. Let's go to SoFi. SoFi bros for life. And let's say that we bought SoFi. I'm going to pick one at random. I have no basis in this. Let's say that we bought the 25 calls. Okay. The 25 calls at one point were around 80 delta. Today, they're basically 100 delta. Delta means the amount of change in the option price for every $1 change in the underlying stock. So at 100 deltas, which is the max, at 100 deltas, this is going to move 1 for 1 with the market. Now, 80 deltas here is going to be less expensive. And hang on, let's go with instead of 28.5, let's go with the 29s. That's going to be the 78 delta. Lots more liquidity here. So let's say that we bought the 29s, right? So let's put our imagination hats on. When we originally bought this, it was the 25. Now the 25 has moved deep in the money like that. Okay. Now it's like, well, awesome. I can now take this 25, I can sell it off and buy the 29. And by doing so, I'm taking in a $2.70 credit. Now, if I originally spent $3 on it, so imagine with me, okay? We bought the 25. The OG trade, we bought the 25 strike and we paid $3.90. Okay? Now we're going to roll the 25. Now roll the 25 to the 29. And when we do that, when we sell to close the 25 and buy to open the 29, that takes in a credit of $2.70. Think about it this way. Think about it this way. You paid $3.90 to get into the trade. By rolling from here to here, you're taking in $2.70 of credit, which means you only have $1.20 of risk left in the trade. You paid a debit, you took in a credit, you still have a small debit outstanding in the market. But in the meantime, you've taken in $2.70 of credit, leaving you just a debit of $1.20. Now, if we want to sell to close, we now get to sell the $3.90, right? Sell to close, the 29. We now get an additional $3.90 in credit, which means, let me move this down one line here, which means our total net profit in the trade is this plus this, okay? Because the credit we already took in left us with this amount of debit. We just closed it for that amount of debit to mean our total gain in the trade is $2.70 in credit, okay? We paid this much to enter. We rolled it for that. That left us with this much debit left in the trade. We closed the entire trade now for $3.90, which gave us $2.70. Now 2.7 divided by 3.9 is a 69% gain. That's a wonderful, awesome gain, okay? And we got to take partial profits, as I mentioned, by doing so. We kept the trade on, right? We just moved from one strike to the next at essentially the same delta as where we started the trade. It went from 80 to 100. Now we're going back down to 80. Now, to his point, what's the benefit of that? You get the gamma expansion. In fact, let me rephrase that. You don't get the gamma expansion when you go here. When you stay here, it's going to move one for one. When you go here, it actually expands, meaning for every dollar, your option is going to work better for you as it increases. Okay, that's a really cool thing that it does, right? It actually helps you in this case to roll like that. You're taking partial profits, as we mentioned before. You can do anything you want with those partial profits, right? You can take it out and go to Costco. You can invest it into anything else, but that $2.70 that you originally took out as a credit, that's yours to keep forever. And then this $2.70 is your total net profit overall. And that's a 69% gain. So it keeps the trade alive with the approximate same number of deltas that you started with. And hang on, where's my slide for that? Where's my slide for that? I know there's three things. I just can't remember what the top of my head were there. Takes partial profits now, frees up capital. So you can go trade with anything you want, and it keeps the trade alive. So I hope that answers your question. Manny asks, will Outlier ever get a notification of listed stocks when they go over? Oh yeah. So in Outlier, you can set notifications. Let me pop this open real quick. By the way, Outlier is literally just 82 cents a day. You can set notifications. I think here, I'm afraid it's going to show my email address if I click that, hold tight. Oh yeah, there we go. You can set notifications by clicking this button. So if the fear and greed heat map goes over a certain value, if the new uptrend or downtrend started for a stock, all you gotta do is click that and it'll send you that email notification. So we already got it for you, Manny. We already got it for you, dude. It's too easy. Nate, the whole method to Outlier trading is to reduce risk. Yeah, exactly. The Chris/Outlier plan is to reduce the risk of your investment so that when your plan requires you to roll, you're reducing risk. Precisely. I agree. The risk of your investment in the market or the options you purchase, you take the debit in every time you you're taking in a credit. You're taking in a credit. And if you roll, you have to pay something. Okay, good point. Sorry, I misread that. If you're doing the roll for a debit, you've done it wrong. You're adding risk into the trade. You're adding risk into the trade. So well said. Okay. And so under the 10 EMA, how do I know the option is actually down 200 so I can exit? I want to understand how to measure and manage the loss on the option itself. Okay. So under the 10 EMA, right? Let's go to cake. We saw that that is under the 10 EMA. So your option is going to be going from in the money to out of the money. Okay, so it's going to be moving from like the 3250s up to the 45s or whatever, right? It's going to be moving closer to at the money or even out of the money. And that's part of it, right? If you are in a trade and it's not working, it's going to be moving closer to the money. I understand how to measure the loss in the option itself. You know, your price that you bought it at minus the price that you could sell it and get out of it today. I'm not entirely sure on that question. Close your trade if it closes under the half ATR. So that was part of our plan before. Let's share the new plan exit signals. So plan A exit signals is an outlier sell signal, close under the 10 EMA, hitting an outlier block, any earnings, or a gap and crap. Plan M exit signals are an outlier sell signal with a 10 or 20 bearish cross, an outlier block, earnings, a gap and crap, or a 2 ATR stop from entry, or an emergency exit at 3 ATRs. So those are my exit signals on there. Now plan ETF, which is what we're in now, a sell signal, a bearish cross, any order blocks being hit, or close 3 ATRs above the 20 EMA. Okay, could he send another one? Does the 80 delta call naturally turn into a 90 delta as price moves? Yes. That's a good question here. So let's go back to SoFi. It's more liquid. Let's go back to SoFi here. So as a stock goes deeper in the money, right? So in the money, at the money means the option strike closest to the current price, $32. Okay. As it goes deeper in the money, okay, all of these have been passed, right? It's past 26, it's past 29, it's past 30. We can all agree with that because price is now at 32. Okay. As it goes deeper in the money, the option delta will rise. Now the amount of rise changes, right? From here to here is 6, here to here is 5, 5, 5, 4, 4, 3. That just changed on me. Point is that as it gets deeper in the money, it's going to go closer and closer to 100, but it cannot cross over 100 because for every one share is one delta. And options are built on contracts of 100 shares, so it can only go to 100 and max out. It can't go any higher than 100. But the further out of the money you go, you can see it goes down to, you know, possibly almost zero. And one way to think of this too, a lot of people look at it like this, is how likely is this going to be in the money expiration? At the money is basically a 50-50 shot, right? Which we would agree to that, right? At the money is a 50-50 shot because it's got a 50% chance of being in the money and a 50% chance of being out of the money because it's right at the money right now. Where I live in the 80 delta zone, there's already an 80% chance that the option that I bought is still going to be in the money at expiration. So you're already on the right foot. You're already like with a huge advantage. But there's people who buy the 20 delta, which is the opposite of my 80 delta. People who buy the 20 delta as a lotto ticket, as a YOLO call, and they're like, it's only got a 20% chance of going in the money at expiration. That is a terrible investment. I would much rather start Scrooge McDuck style and have all the moneyness built into my options trades long before ever having to hope and pray that it'll go in the money. It's already deep in the money. I don't have to do anything about it. When you roll, do you sell the 90 delta and reopen an 80 delta? Yes, that is exactly the roll. You're moving from 90, 80, 7, whatever, back down to roughly an 80. And it doesn't have to be an 80, right? 80 is just the ballpark. Sometimes I'll go 72. Sometimes I'll go 91. That more depends on liquidity than anything else at that point. Rogers says, what do you think about having a trigger in place to auto close when the trade goes against you? And those of you who have been watching for a while, I have a huge disdain for automatic orders. The reason being is the spreads on anything, even the most liquid stocks, can widen out. Okay. So this may be 15 cents, but as things progress during the day, if prices happen to move a lot more during the day, the spread, the bid and ask spread, will widen out. there is a chance, and it has happened to me, which is why I know this, that your option trade will get automatically triggered to close when it never needed to. The spreads naturally widen out and contract at different times of the day. And then all of a sudden your trade is gone when you go look at your portfolio and you have a huge loss and you're like, what just happened here? The spread widened out and now I'm out? No. So now that's my personal style. I only trade manually because I want that control. I don't ever want it to go against me and have no control over it, right? Would you roll when it hits the 100 delta, even if it didn't hit the ATR? That's a great question. No. I mean, the point of the ATRs on a chart, right? The point of even having, in fact, with the deep thought indicator, let's just pull up one let's go to Tesla. Oh no, that won't help us. Let's go to a lot of red up in the market today. Let's go to Amazon. Let's say that I bought Amazon today and I added this part of the deep thought indicator, which is, where's it at? Hold on, he was teaching me how to use it yesterday. Show current plan markup template. Boom. How cool is that? With one button. Hang on, I want to take out this little guy down here. Position sizing table. Yeah. Cool, check this out. The reason I have this here is so you don't have to second guess, right? The 1 ATR, 2 ATR. The only reason it's there, the only reason it exists at all is just to give you a point of reference on a trigger to know when to do something. Do you have to do it then? No, of course not. You could roll literally 5 minutes after you bought it, you can roll it. Do you need to? No, not really. But this gives you a reason to roll. Does that make sense, right? The trade's working for you, and so therefore you can use that to your advantage. You don't have to do anything before that happens. That's a great question, though, MT. I appreciate you, my dude. So you roll up to the 100 or 90 delta, and then you sell to close and buy another. Okay, so let's not overthink this. The rolling, as complicated as it sounds, is nothing more than taking the original trade that you had. You own the 25. You're going to sell to close it, buy to open the next one, right? So you're just moving up the options chain. That's it. You can do this as two separate orders, right? You can sell to close and then buy to open here. I know that there's some people who their broker, I don't understand why, their broker doesn't allow them to roll, but all you're doing is closing the original order and opening a new one closer to the money. It's really that simple. It really is that simple. Vincent has a great question. Can you all please smash the like button? Can you all please smash the like button? I agree with that. And Outlier University covers it all. Did somebody say Outlier University?
Are you ready? Let's go!
Respect is earned. Respect is never given.
That is right. Outlier University is back in session this afternoon. We are still working on the foundations of trading. So it's still going to be, this is our first week of probably 6 or 7 weeks. And we have 9 students who are participating live in class. And it's a $12,000 value that we are giving away 100% for free. As a member of Outlier, you get to watch the live stream, ask all the questions that you want, and that will then go on the replay on YouTube, and it will live out there forever. There is nothing I'm holding back. There is no additional fee for this. There are no paywalls other than just being an Outlier member that you have to go through. No hoops whatsoever. There's no email address you have to type in. It will live on YouTube forever, and I will teach you everything that I know about trading. Now, the cost of admission, however, is making sure you share it to at least 5 people. At least share it to 5 people. Now, we've already gone through the alpha class. Now we're working on the Bravo class. So I'm super stoked. That'll be this afternoon, the normal time that we go live, which is 2 p.m. Central Time. And again, the replay will be up tomorrow morning, and it will live on YouTube forever as our way to help you be successful. All right. That is the plan. Our plan is to get you to be successful. That is Outlier's whole goal. Give you the tools, give you the strategies, give you the education, give you the everything so that you can go and make incredible financial decisions and create generational wealth in the process. So if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos, and we'll talk soon.